So, when you see a stock price just bouncing all over the place day after day, have you ever just stopped and wondered, hey, what is this company actually worth? Without all the market noise? Well, today, that's exactly what we're going to figure out. We're on a hunt for a company's true underlying value. Let's get into it. This is it. This is the big question in investing, and it's kind of the mystery we're going to solve together in this explainer. And here's a hint. The answer has almost nothing to do with that flashy ticker symbol you see on TV. It's all about understanding the business itself. Okay, so first things first, we need to get our heads around two totally different ideas. Over here, you've got the market price. That's the one that's all over the news, right? It's driven by headlines, by fear, by excitement, and it can change in the blink of an eye. But then there's this other thing, intrinsic value. This is calmer. It's the calculated fundamental worth of the business, based on one thing and one thing only, its ability to make cold, hard cash. All right, to really get a grip on this idea of intrinsic value, we're going to take a little detour. Let's forget about spreadsheets and stock charts for a minute. Instead, I want you to just imagine you have the chance to buy a magic money machine. So how much would you pay for this machine? Well, to figure that out, you'd probably ask three really simple, logical questions. First, how much money is this thing actually going to spit out every year? Second, what's the risk here? How likely is it that it might break or just slow down? And third, and this is the big one, all that money it's going to make in the future, what's all that worth to me right here today? Honestly, those three questions, they're the secret to everything we're talking about. And here's where it all clicks together. A really great business, it's not that different from our magic machine. Seriously, it's just a more complex version that instead of literally printing money, it generates cash by, selling stuff. But the core logic for figuring out what it's worth, it's exactly the same. And that logic, it actually has a name, discounted cash flow, or just DCF. Now I know that sounds super technical and maybe a little intimidating, but it's not. It's really just the official financial way of answering those three simple questions we asked about our money machine. It's all about figuring out what a business is worth based on the cash you expect it to make down the road. So what are the ingredients we need for this DCF recipe? Well, there are three main parts. First, we need to project, or let's be honest, make some educated guesses about the company's future cash flows for, say, the next 5 or 10 years. Then we need something called a discount rate. Just think of this as a way to penalize future money to account for risk. And finally, since a good business doesn't just stop after 10 years, we need a terminal value, which is just an estimate of what it's worth for all the years after our forecast. Now, that whole discounting thing is based on probably the most fundamental idea in all of finance. It's simple. $1 in your pocket right now is worth more than the promise of $1 next year. Why? Because you could take that dollar today and invest it, and by next year, it would have grown into more than $1. It's just common sense, right? Let's make this real. Imagine we do our homework on a company, and we predict that 5 years from now, it's going to generate $100,000 in cash. That's great. But the key question is, what is that future $100,000 worth to us today? And boom, this is the power of discounting. If we apply, say, a 10% discount rate to account for all the risk and the time between now and then, that future $100,000 is suddenly only worth about $62,000 in today's money. See what we did? We just pulled its value out of the future and back into the present. Now, the full DCF process is really just rinse and repeat. It does that exact same calculation for every single year we forecast. It takes the cash from year 1, discounts it back. Takes year two's cash, discounts it. Year 3, and so on. And then, at the very end, it just adds all those present-day values together. And that grand total, the sum of all that discounted future cash, that gives us the magic number. That is the thing we've been hunting for this whole time, the company's intrinsic value. It's our best estimate of what the entire business is fundamentally worth, right now. Now, you might be thinking, wow, that sounds like a ton of math. And you're not wrong, it can be a bit repetitive. But here's the good news. You definitely don't have to do it all by hand on a napkin. This whole process is made way, way simpler by using a tool like a DCF calculator that handles all the heavy lifting for you. So why on earth did we do all this work? Well, this is the payoff. This is the moment of truth. You take the intrinsic value you just carefully calculated and you compare it to the current market price. If your value is way higher than the stock price, you might have just found yourself a bargain. And if it's lower, well, the stock might be way overpriced.
So, the big idea, the one thing to take away from all of this is really simple. A stock price is what you pay, intrinsic value is what you get. The entire goal of this exercise, the whole game really, is to find those awesome opportunities where you get to pay a lot less than what the thing is actually worth.
And that just leaves us with one final question to think about. After all this, what do you think value really is? Is it that frantic, emotional price you see flashing on a screen? Or is it the patient, thoughtful number that you calculate for yourself?